Once part of the chain hops off, then the chain hops off for everyone, and we have the risks of a bubble-like crash scenario. A financial market bubble occurs when expectations, as expressed in market prices, go beyond what can be sort of realized on any reasonable time horizon. We're pricing in maybe 10, 15, even more years of growth that would have to be fantastic to justify the current market price. Now, how do we get there? And that's really the issue behind a bubble. To get to these kinds of prices in the market, there has to be some kind of narrative, often based on a technology that is driving this excitement, this fear of missing out, this anticipation that the only way is up. Historically, some say, and conventional wisdom says, that you don't know that you've been in a market bubble until you've seen the crash. But there are a number of times throughout history when it's been quite clear you're in a market bubble. One of those markers is, again, prices for the underlying instruments, when these are at these levels that are pricing in incredible growth on very long time horizons to justify that current price. And then we have the irony that these bubble cycles of market pricing actually spark tremendous investment that have tremendous implications for the long term for our economy and can produce very productive things over the long run, even when the short-term financial part of the cycle can be at times devastating for those that timed it poorly. If we think all the way back to canals, we had a huge financial bubble in canals in the US, for example. The canals were there and allowing very cheap commerce after the bubble was long gone. Similarly, we saw the railroad build out. We also saw a bubble just ahead of the Great Depression with cars and with radio. These were technologies that stayed around, to say the least. And of course, we all remember the internet build out and the financial crash that resulted from the very top. I think we can all agree we're still using the internet, and it continues to have profound implications for our life. I think it's quite easy to recognize that we are in an AI bubble right now. First of all, it's really important to point out that while I think it's fairly easy in some cases like we have right now to recognize that there are bubble dynamics afoot here, it's impossible to time these things. Where are we in the bubble? It's impossible to know. We could be, to use an American baseball analogy, in the third inning, the sixth inning, or even late in the ninth inning or extra innings, who knows? But there are some markers here for why we are in a bubble. But first of all, there's of course the valuations. Now we can take the biggest company of all associated with the AI bubble, and that's Nvidia, the maker of the chips that are at the heart of most of data centers that are crunching the numbers and driving these AI calculations and so-called large language models, etc. If you look at Nvidia's past growth performance, its current valuation is not particularly unreasonable. And in fact, if it continues to grow at these types of rates, you could argue it should be at even richer valuations. But is it reasonable to expect that this much of our economy will continue to be poured into these investments at ever-growing rates when we're already investing the equivalent of something like the entire Apollo space program in the US on a GDP-adjusted basis every year into data centers? I would argue perhaps no, but I can't tell you if that growth rate slows down in the next 3 months or the next 3 years. And then there's a particularly dangerous dynamic within this particular bubble, which was evident in some past bubbles, particularly in tech and telecom, but is very present in the current bubble. And that is the so-called circular economy within AI. It's about one company investing $100 billion in another company, which in turn invests that same $100 billion in another company, and so on. It goes around. So we have Nvidia investing in OpenAI, which then builds Nvidia chips. You get a cloud provider that is booking the revenues to build out data infrastructure, and it goes around from Oracle into OpenAI into Nvidia, etc. Once part of the chain hops off, then the chain hops off for everyone, and we have the risks of a bubble-like crash scenario. Again, with a bubble, you have to have something really special when you have a very large financial market bubble. Some really special driver, some sort of this time is different mentality. This time is different moment was realized with the introduction of ChatGPT. I think almost all of us could feel that when we pulled this thing up for the first time after installing it, and we started asking it questions, and we're stunned at the way we could naturally interact with natural language with a model on anything under the sun. And many of us immediately realized the productivity potential of ChatGPT and interacting with ChatGPT and its competitors out there. On the sort of more nefarious side of things, many students might be out there who will say, look, this has enabled cheating on a grand scale. I can get a paper ordered up in the space of 30 seconds. On the slightly more inspirational and productive side, we all know that we can use ChatGPT as a source of inspiration. We're stuck on how to get started on a project, how to organize ourselves. It can give you an answer in a space of seconds to provide some bullet points on how to get started, how to structure whatever project it is you have in mind, even if it doesn't provide you the comprehensive answers for everything, and you have to do that part for yourself. And some of the most compelling, some might even say creepy, and world-changing bits that we're seeing now are in the space of physical AI. And that is being realized in the form of these humanoid robots. Now, some say that humanoid robots are just a step too far. You know, we've long thought this was the future of technology, to see something in human form doing all these tasks that humans do and replacing us en masse, even in the physical world. They say that robots, there's endless room for AI to innovate in the physical world with much simpler things, robotized delivery vehicles, drones, what have you. But I still think it's these humanoid robots that are driving an extra angle and an extra impetus and momentum behind, you know, why this AI narrative is so positive. Whether these things are actually more like 20, 30 years down the road, rather than something that's going to be helping us to do our laundry in the space of the next year, which is what at least one Norwegian-based physical AI startup is hoping. Yeah, what causes a bubble to end? Often, in hindsight, we can probably trace it back to one single incident in the financial markets, that missed earnings report that just didn't quite live up to expectations. Yes, we're going to grow, but we're going to grow at 19% and not 37%. Or there's a profit miss. Whatever the sort of single event, some key player that has a key financial expectations miss over an earnings call or a profit warning. And I think, again, with this circular economy problem within AI, this is a particularly potent risk with this specific bubble we're seeing now. And so that potentially spells the end of the exponential growth phase. And again, this is not to wax too negative on the whole space. AI is an incredible technology that will continue to resound for coming years, decades, and millennia, really, as we discover what this technology means for us. What are steps we can take to not just panic and run away, but to take reasonable steps to rebalance things? And I think that word rebalance is really critical here. If, for example, you invested in a evenly weighted index some time back, and your AI names and some AI names were in that, those AI names have likely performed very, very well. So actually your exposure to the space has become even greater as a percentage of your portfolio than it was at the time. So you can simply look to rebalance a little bit, rebalance to what is a more evenly balanced exposure to AI relative to other areas of the market. That's everything from standard industrials, cyclical stocks, even stocks that are involved in basic materials and other industries across the market. But we should also look at cash, and I don't mean 100% cash. I'm talking about if you're traditionally allocated 2% in cash, 5% in cash, to have a larger allocation of cash, 15, 20+%, as optionality. What do I mean by optionality? Cash as optionality means that if there is a dislocative event in markets, you have a pool of cash to invest when markets are in a different place. When markets are high, expected returns in the market are generally lower than they are, of course, when markets are low. What I mean by expected returns is the return you can reasonably expect on your portfolio over time. When market valuations are extremely high, as they are now in the case of the world's largest market, the US. In fact, we are at record high valuations for a stock market where we're seeing record high profits. So what if profits go down and valuations normalize? We're going to have a slightly dislocative event, to say the least. With cash, you've got something to put into the market. This is the current Berkshire Hathaway stance on markets. We've seen Warren Buffett in his swan song at Berkshire Hathaway. He's about to step out. He has one foot out the door here, taking off their bets on the market broadly, and they are over $300 billion in cash. Because why? Because the valuations and the expected returns are not attractive, and they're waiting for valuations to become more attractive before putting that capital back to work. And often in the case of market bubbles, there are companies that have incredible roller coaster rides. They go from a boom cycle to a bust cycle, but they remain very, very good, solid, and growing companies that become opportunities because the pricing dynamic has changed. Think about Amazon.com, an incredible bubble stock, tremendous bust there, and yet it was a fairly solid investment in the teeth of the whole loss of faith in the returns during the dot-com bust. But the general message really remains here. The first thing is to never panic and to be thrown around by our emotions. And the second one is to the extent possible, and this is very hard because we all are sort of hardwired to act like sheep in this world, and that is to behave a little bit against the crowd. When everybody is starry-eyed and wild-eyed and your Uber driver is talking about their latest killing in the market, that's when we should be a little bit cautious and more defensive. And when everyone is depressed and giving up hope and the markets are in dire straits, that's when the opportunity is greatest.